Good morning, everyone. Nice to see you all here. Didn't we? We obviously were wondering how many people would be interested in coming, given the markets of late. But I'm very glad to see you all here. It's been it's an interesting moment for sure, and there's a lot of opportunity out there as long as you've got, I think, the right time frame perspective going on. That's what I'm going to talk about today, for sure. Is what's ahead, what sort of time frame I think that might be on. What has changed in the last few months since I was last at this podium, and then happy to introduce these three gentlemen to tell you about what they've been up to. So I will, without further ado, just get started. When will we get a metals market? The question that we all want to answer all the time, right? So last time that I was here, the talk that I gave had a bit of a different structure. I sort of looked at interest rates, what investors were interested in buying, and how inflation played a role in that before the Great Financial Crisis, after the Great Financial Crisis, so once we entered the mode of central banks being central to everything, investing, and then in more recent times. And I looked at that in an attempt to answer the question, how are things going to look for investors once we get to the other side of this tightening cycle? And my conclusion a few months ago, this was in early September, I guess, is that it'll really depend on whether investors remain focused on growth, which has been the only thing that investors have bought, right? Really since the Great Financial Crisis, and especially since COVID, it's been all growth, tech, speculative, everything. So will they remain focused on that, or will there be a shift to an interest in value investing? And then the severity of whatever recession might come from the tightening cycle. I thought those two things would determine the shape of the metals opportunity. And this was the table that I created to try and capture that. I put this up to start because a few things have, of course, transpired in the last 2 months. You're all aware of these, so I will run through them quickly, but first of all, inflation has not eased. If anything, it keeps going up, the core numbers, at least, that the central bank is most focused on. So our rate hike cycle is not over yet. And this is just a reminder, not that we really need it, but anyways, that metals are not going to go anywhere much until this tightening cycle, this storm, is over, because investors as a whole do not invest in economic growth when markets are sliding and everyone's talking about a recession. That's just not how it works, okay? So that's just a reminder that patience is such a virtue. But the other big thing, and I'm gonna talk about this quite a bit today, is that we've really seen some change in the investor focus on growth versus value. So, I mean, big tech stocks, especially in the last few weeks, have really cratered. And I think that this is, or to me, this is giving me more confidence almost on a daily basis that we are going to see a shift in investor focus from what has been the thing for the last decade, speculative growth, tech, that's the only thing that's worth buying, to things that are a bit more based in fundamentals, in cash flows and supply demand and things like that. That's what's happening right now. That's what the markets are doing. And I think that the way that this has played out over the last few months has given me more confidence that we're getting back to that sort of investor perspective. And then, of course, there was this whole thing that happened in the UK. There was a lot of things that happened in the UK, where, of course, a big sharp declines in bond prices triggered a whole vicious cycle of selling from pension funds who had been mandated to own bonds, blah, blah, blah. And all of that had the potential to crash the UK system. The reason that that matters is because it's a reminder that there is a real risk of systemic crisis. I'm not going to spend a lot of time talking about that today because those things are black swans by nature. I mean, Eric and I were just chatting about that this morning. Like, we don't know if something like that happens. We're not going to know ahead of time what it is. But when things that have been stable in a financial system for a long time suddenly change, the risk of something breaking is pretty high, right? So the possibility of a systemic crisis is real, and that could turn things on their heads in ways that are very difficult to predict. So if I just go back for a moment, Where I think that this leaves us relative to my table from last time is that I think we're just more on the upper line of this table. I think we are seeing investors rotate to fundamentals, and I don't think that that's going to, I think that that will persist. As to the recession question, jury's still very much out. We shall see, but I really think that we're more on the upper line of the table as opposed to the lower line. We're just going to have patience because none of this is going to start until this rate hike cycle is over. Now, of course, I mean, this is a very common chart to see these days. This is inflation. We'll get a new print in about a week that includes the October numbers. And I just include this as to say again, investors don't invest in metals broadly until the conversation involves growth, economic growth. And right now that is not what the conversation involves, right? Right now the conversation is about recession risk and market sliding and China worries and all of these things. So we're not there yet, so we're not going to see a turnaround in interest in metals particularly soon. I also want to emphasize, as much as traders continue to obsess over wanting the Fed to pivot, I really don't think that the Fed is going to pivot. I think Powell reinforced that just 36 hours ago when the statement included a line, the statement after the Fed hike included a line that some people thought might be slightly dovish, and then he was like, no, we're nowhere near, it would be premature to even thinking about stopping what we're doing. And you're like, yep, that's probably true, because we have lots of examples of the Fed pivoting too soon, and it didn't work out well. I would say that there is never an example of the Fed over-tightening us into an excessive recession. Of course, the details of that can be debated, but like too much tightening would be shoving inflation down below 2%. Well, this is a long-term inflation chart. And even in the Volcker era, inflation didn't get shoved below 2% when rates went legitimately through the roof. So we don't have an example of tightening too much. I don't think Powell and his friends are particularly worried about tightening too much. And does anybody really think that pushing rates just above 4% is suddenly going to pull inflation from where it is down below 2% with any kind of speed? For sure, monetary policy works with a lag. I get that we don't know yet how much these rate hikes or what exactly these rate hikes will do. But this chart, I think, is really interesting. I think it shows that you would need to have, it's probably hard to see because the numbers, the writing is very small, but the red line looks at if inflation stayed at the post-COVID inflation average. The green line assumes zero inflation for the rest of the projection period, so through to the end of 2023 or the middle of 2023. And you would still end up with inflation at, what is that, 3.9% if inflation suddenly went to zero, right? This is the scale of the challenge ahead for inflation, right? It really needs to be pulled down a lot for the difference that the Fed wants to happen. And so I don't think that we're going to see a Fed pivot anytime soon, and I think that that's just really important to remember. And I know we're all tired of talking about rates because we've been talking, everybody talks about rates ad nauseum. I'm tired of hearing myself talk about rates. I'm certainly tired of thinking about them, but the market reaction on Wednesday was just a good reminder of how this is still central to everything, right? There was what markets did when the FOMC statement came out, when people are like, there's like a slightly dovish moment in that paragraph. And then Powell started talking and they were like, oh no, they're still tightening. That is how important tightening is. It is the thing that matters. Okay, so we're in this tightening cycle. Obviously, that's pulling markets down. It's very easy to just say, okay, the markets are crashing, but it's a lot more nuanced than that, actually. And I think the nuance is something that I'm going to spend some time on right now because I think it's quite important for metals investors. Big tech stocks have done very badly in the last little while, but the rest of the market has just corrected. It's a fair, and because the FANG plus stocks are so heavily valued in so many indices and are just so behemothly large, they have outsized influence on the overall numbers. But if you look at the average S&P stock, it's actually just corrected. It hasn't done that terribly badly. This shows the FANGs versus the S&P 500 equal weight. Well, the average has now outperformed the FANGs. Like, the FANGs are the ones that have really come down. Meta is a great example, of course. I mean, it has carnaged in the last little while. But look at some of these numbers. I mean, Meta today trades just above 9 times trailing earnings. A year ago, it was at 37 times, right? So that's a big change. The S&P as a whole trades at 18 times. So Meta is now dramatically trailing the average of the S&P as a whole. So I take that as a very significant shift in what value investors are placing on tech growth stocks, right? I'm not making projections about what Meta is going to be worth in a few years. Is Mark Zuckerberg correct in outlooks for what the metaverse is going to be? That's a completely different question. What matters right now is that I think investors are returning in this moment to the basics of cash flow and balance sheets and things like that, as opposed to just buying tech stocks because they keep going up. Because tech stocks are decidedly not going up anymore. And this is a dramatic shift. This is a big change relative to what we've experienced for the last decade. And these changes can happen when investors face a grand reckoning. And guess what? It's been a grand reckoning. That red line shows how the average 60% stocks, 40% bond portfolio is facing its largest annual loss in 100 years. That kind of moment causes investors to reassess what they're doing. And I think that reassessing is happening. A few months ago, I wanted it to be happening. I think right now it is happening. And that's the change. I think value is rising as growth falls. And so we are in a return to value. And I really think that that's important. And this is just, I probably talked about this for too long already. This is another way of capturing that. Expectations for earnings growth show that investors have almost no faith now in growth. That's the red line. That's their expectations. So the wild optimism over tech stocks, it's done. Whereas, you know, the nuts and bolts, the companies that earn money, the companies that, you know, produce metals, I think are the ones that will attract interest once investors decide that it's time to deploy again. And metals certainly fit that bill, right? Metals are a value play. As I've just been saying, since way back in the great financial crisis, it's been tough for anything other than tech, growth, spec to do well. If we look back as a parallel to the tech bubble, I mean, I'm not saying by any means that the recent times and the tech bubble are perfect analogies for each other. There's lots of differences there, but there's also lots of similarities. Rampant speculative interest in growth happened both times, and then there was a dramatic shift, and interest shifted over to value stocks instead. And I mean, during that time, value fund managers during the tech bubble, they lost their jobs, man. Like, they were like, people decided for a while that growth was the only thing that was ever going to happen. That was literally the conversation that was happening. Only 14 months ago, people were still on the growth bandwagon. That's when Meta was trading for 37 times earnings, right? It's now trading for 9 times earnings. When these things change, they can change dramatically. And so once we take this change and place it into an environment where people are once again considering economic growth, we got to get through the tightening cycle first. But once we put this new perspective into a situation of economic growth, then metals really work. Back in the 2000s, yes, metals soared, and that was supported by this massive story called the China growth story, right? I get it. That was clearly fuel on like a simmering fire. But I would argue that we have a similar setup today in that the green transition is really ramping demand for metals, and there has been so little supply response for almost a decade to that increasing demand. So the fundamentals are really in place. We do have really strong demand. We do have insufficient supply, and we have investors shifting their interest to this kind of play. So I think that despite the fact that the moment still feels pretty dark, and recession worries continue to steal momentum from this sort of secular shift, The secular shift will happen. We just have to get through the moment. I'm not going to spend a lot of time on this. These are slides that talk about how strong the fundamentals are for some of these metals, especially the ones that are being particularly propelled by the green transition. I mean, copper, the middle of this decade, sees the largest deficit ever in the copper market. This isn't some small market. This is copper. This is the PhD of metals. We need way more copper, and it just doesn't exist. Silver, I kind of love talking about silver because silver is in a supply shortage in a few years, even without considering the fact that solar panels are using more and more silver with each generation. And we need to make, and projections are that we're going to increase solar panel use almost tenfold. I mean, these numbers are hard to wrap your head around, and there's nowhere near enough silver to meet that demand. Uranium, I mean, there's been a nuclear power renaissance for sure, with several drivers, some expected and some less expected. Nonetheless, it's happening. New supplies are very limited. Of course, there's interesting pressures adding to that situation, like the Sprott Physical Uranium Trust and everything to do with Russia and how it relates to uranium. I mean, lithium's been the shining star of the mining space. Those who have owned lithium stocks over the last few years have something that works in their portfolio, woohoo! But I still think that there's upside for lithium. I mean, lithium, what I like to say about lithium is that it's really hard to realize how quickly this market is growing. 20 years ago, we used lithium to like make ceramics, and a few other things. We hardly used lithium for anything. Now lithium is supposed to go into every battery for every electric vehicle. As electric vehicles cross that 5% threshold in the major markets around the world, I mean, it's a dramatic explosion in the scale of a market. And so to try and meet that demand growth is a huge, huge challenge. I mean, gold, I talked about those other metals first because they are, the outlooks for them, to me, are a lot more clear. The outlook for gold is much more difficult to understand. Certainly, interest rates are rising, but inflation is still strong. I mean, so real rates are rising and probably will for some time. The US dollar remains very strong. I don't think it's going to come down much soon. And at this point, gold is not getting help from a broad bull market. That could change. When a broad bull market happens, usually most metals go along with it, including gold, even though it is not, of course, an industrial entity. But I don't see clear catalysts for gold in the near term. Adding to that is certainly the fact that gold doesn't usually perform well in the first half of a recession. All of the charts and metrics that show that gold exposure helps your portfolio coming out of a recession are about people who buy gold partway through, because gold recovers first and moves fastest out of a recession. But that doesn't mean that it outperforms in the first half. It falls right alongside everything else. So I don't see a lot of impetus for gold in the near term, but we shall see how that goes. So the shape of things to come, just a bit of a summary. Metals won't get attention until investors generally are of the expectation that we've gotten back to growth instead of recession. So we got to get through the hiking cycle. The Fed is not going to pivot unless there's a crisis, right? I mean, I'm quoting myself here, which is a bit of an arrogant thing to do. But anyways, this is a quote that I found from my own newsletter, and I included it. Central banks buying bonds constantly for the last 12 years amplified the trend that we had, which was falling bond yields, right? Immense pools of money positioned for that. But when everything is positioned for the same thing, and that thing suddenly changes, and changes dramatically, watch out. Especially when the thing that changes is a massive, must-own, low-risk market, right? It just creates potential for systemic risk. So something could happen. If there is a crisis, that'll be the opportunity for gold, right? So that's something for gold-interested players to think about. And the metals market ahead is very well supported. There's no rush to buy anything right now. But I would say that metals investors who do not position before the rate hike cycle ends will probably be a bit annoyed at themselves, because when it changes, it could change quickly. I don't think that that's right around the corner, but I do think that when it happens, it could happen quickly. So what do you want to buy? I mean, I think there's a lot of advanced projects of scale out there that are very undervalued and could well get snapped up when this market shifts. I think there's a lot of under-recognized discoveries because there's been so little buying in the market. There's been so little investor interest in our space that there's been some pretty great discoveries that have gotten very little recognition. And I don't mean maybe brand new discoveries. So some brand new discoveries or some discoveries that have grown significantly that just aren't getting any attention. And then companies that are able to use this downturn to position for growth. That sounds obvious. There's a lot of things out there that you can buy for cheap. Obviously, companies should be going out there and buying things. It's a lot harder than you might think to have sort of the gumption and the capital to go out and make big deals right now, or even medium-sized deals. It's hard. But if you can do it, then I think there's the opportunity for smaller operators to position to become mid-tier operators, and that's a very different valuation. So that's something that I'm watching. And of course, top-tier explorers that have compelling targets and momentum. Discoveries will work in almost any market. They're, however, some of the hardest to actually pinpoint. And that's all I'm going to say.